This is the Fun and Sexy Finance Show, where we talk about all things money, so that you can learn how to make your money work hard for you instead of you working hard for your money. Hi, I'm Susie Fabrocini, and I want to welcome you to my show, the Fun and Sexy Finance Show. Today we're going to talk about mortgages. Now, what's sexy about mortgages? Well, mortgages are a very powerful financial tool. If you had $400,000 in your account and you wanted to buy a home, would it be smarter to pay cash for a $400,000 house and then live there debt-free, or to buy 3 $400,000 houses, put $100,000 down on each one, get a $300,000 mortgage on each one, and then still have $100,000 left over for unexpected expenses? Now, I'm not saying that the answer is going to be the same for everybody, but it's something to think about, right? Now, there's a lot of rules around mortgages, and it's really important that you understand them, because knowing the rules around mortgages can save you thousands of dollars. First, there are fixed rates and there are adjustable rate mortgages. The fixed rate mortgage has the same interest rate consistent for the entire life of the loan. An adjustable rate mortgage, however, usually starts out lower and then changes over time, usually going up. There are several reasons to be wary of adjustable rate mortgages. The adjustable rates usually start at the lower end, and oftentimes the mortgage broker or the loan officer is going to recommend them because it may be easier to get you qualified for the loan at that lower rate. But then you have to be worried about how high can this rate go? Is there a cap on it? What would be your payment at the highest interest rate? And can you afford your mortgage at that interest rate? This is where people get into trouble. They don't realize that that could happen. They go on the advice of their brokers, they get the lower rate to start with, and then when the rates start to go up, their brokers or their loan officers recommend that they refinance. Of course, because that's how they make their money, by making new loans. And I'm not trying to say that mortgage brokers and loan officers are shifty. I'm just saying you need to be aware. Because if you cannot refinance your loan for some reason, like your circumstances have changed, your job's different, the economy has changed, the rules have changed, which they do, and then you can't refinance and you can't afford your payments, you're in a position then where you have to sell your property or lose it. And if the economy has changed and the property values have gone down, and now you're underwater, and you owe more than you could sell your house for, then you're really in trouble. That is a situation you do not want to be in. And let's talk now about the difference between a mortgage broker and a loan officer. Usually, the loan officer works for the bank or the finance company, and they help you to put together the mortgage from the selection of programs that that bank or finance company offers. A mortgage broker is more independent, and they are familiar with lots of different financing companies or banks or different kinds of lenders. And different lenders will have different programs and different qualifications. If you decide to go the mortgage broker route, you want to interview them. Interview a few different ones, because actually with mortgage brokers, what you want to do is build a relationship. A mortgage broker who knows you, knows your situation, and understands what your needs are, and knows what the different loan programs are, is going to be better positioned to connect you with the right lender and the right loan program. And they charge for that. They charge for that knowledge. Most broker fees are around 1 to 2% range, some a little more, some a little bit less. 1% is about what I look for, but you may be willing to pay a little bit more for a mortgage broker that you really like. And we'll be right back after this word from our sponsor. So now we'll talk about owner-occupied versus non-owner-occupied. So when you're buying a house for you to live in, that's the owner-occupied. If you're buying a house as a second home, as a vacation rental, or as a investment property, that's a non-owner-occupied. And the owner-occupied homes are going to have a lower interest rate than the non-owner-occupied. So if you're planning at some time to get started in buying rental properties, you might think about first moving into the house and buying it with an owner-occupied loan, and that way you get that lower rate. And then when you start to rent it out, you move into another property and you set up your loan with an owner-occupied rate again, and do it that way. If you're dragging a whole family along with you, that might not work. But if you're single, it could be a good deal, or if there's just two of you. And then there are qualified versus non-qualified loans. If you hear a mortgage broker talking about QM or non-QM, that's when they're talking about qualified or non-qualified. So a qualified loan is the easiest kind of loan to do. That's when the borrower has a steady job that they've had for at least a couple of years. They get a W-2 from they have a regular paycheck, and they make good money. They usually have a high credit score and a low debt-to-income ratio. These kinds of loans are so easy that they can be done online and a computer can qualify them. So when we talk about qualified or non-qualified, we are not talking about whether the borrower is qualified or non-qualified. We're talking about whether or not the loan qualifies for government backing. So a qualified loan is backed by the United States government through programs like FHA, Fannie Mae, Freddie Mac. It means that the loans are insured. And it means that the lender is protected from a borrower who maybe can't make their payments and then they want to sue the lender. It protects the lender. So those loans usually, always, those loans are going to have a lower interest rate. There are more rules around them. The government makes rules so that they don't get stuck with bad mortgages. The rules for the borrower are that they need to have a good job that they've been at for at least 2 years, and they get a regular paycheck with a W-2 at the end of the year, and their debt-to-income ratio cannot be more than 43%. The rules for the lender, there's a limit to the upfront points and the fees that they can charge. No loan can exceed 30 years, and no negative amortization can take place. Amortization is when you spread the loan payments over a certain number of years. A 20-year amortization means that the loan and the interest are paid over the course of 20 years, and then the loan is paid off. The same loan, amortized over 15 years, would have higher payments, but the loan would get paid off in a shorter period of time, and so they would pay less interest. A 30-year amortization, the payments would be lower, but they would go on for longer, and ultimately the total amount of interest paid would be more. Negative amortization actually allows the balance owed to grow over time because the borrower is paying less on their monthly payment than the amount of interest that is being added to their loan. That's a no-no for qualified mortgages. And just on a side note, the place where I see negative amortization most often has been with student loans, where the student gets the loan down to what they can afford, but the interest is actually piling up faster than that. And so their loan ends up growing and growing. You want to be careful of that. Sometimes loans are set up with longer amortization periods than the actual term of the loan. So that would be like if you had a loan that was going to be due, the balance was due in 5 years, but it's amortized over 30 years. That makes your monthly payments smaller during the 5-year period, but at the 5th year, then you have what is called a balloon payment, where you have the whole rest of the loan is due. In those cases, you're going to need to refinance in advance of that payment becoming due, or sell the property. Balloon payments are another thing that's not allowed with qualified mortgages. Also, loans with interest-only payments are forbidden with QM, or qualified mortgages. A non-QM loan, or a non-qualified mortgage loan, is considered a non-traditional loan. And it's not called non-qualified because the borrower doesn't have to be qualified. You still get qualified. They're still underwriting, they're still going to check you out. It just means that you won't qualify for a traditional mortgage, and therefore the mortgage won't qualify for government backing. So non-qualified mortgages are good for people who don't get a regular paycheck. So people like entrepreneurs or contractors, self-employed people, independent contractors, investors. Those are all people that can fall into that category. These loans are generally more complicated to get approved. The lender's underwriters have to look at different kinds of documents depending on which kind of program they're going to use to qualify the borrower for the loan. And different lenders are going to have different programs. They may have a program for business owners, in which case they'll be looking at 2 years of bank statements, personal and business, to check their cash flow. For a real estate investor, they'll be looking at the cash flow from the rentals versus their expenses. For a stock investor, they might have what's called an asset depletion program, where the qualifying is based on the value of their total assets of stocks and bonds and cash and whatever other kinds of assets they have. The most complicated and the hardest to underwrite are the people who span across all the different categories, who have W-2 income and self-employment income and investment income, because that requires checking documents against each other and doing all different kinds of calculations. It's a lot of extra work. I fall into this category. I am a mortgage broker's nightmare. I have W-2s, I have 1099s, I have my own business, I have investments, I have rental property. It's all but impossible for me to get a mortgage because no single category of income from me could stand by itself so that I could get qualified just on one of those categories. Another thing to look out for is prepayment penalties. There are expenses and a lot of work involved in setting up a mortgage. So the lender wants to make sure that they're going to see a profit from putting you into a mortgage. They want to be well compensated for their time and the risk that they take. So sometimes a lender will build a prepayment penalty into the contract. This means that if the loan gets paid off early, or a sizable chunk of the loan gets paid off early, that the lender will still make a profit. Sometimes the penalty is based on a percentage of the remaining mortgage. Sometimes it's based on a percentage of the interest that the mortgage would have earned if you hadn't closed it out early. One of my loans had a prepayment penalty that said if I sold the property or refinanced the mortgage before 3 years had passed, then I would have to pay the interest that the mortgage company would have earned had I kept the property or kept the mortgage in place for the full 3 years. I did end up selling that property after about 2 years and paid a penalty of about $8,000. Okay, we're going to take a little break now for station identification. And we're back. So now we're going to talk about residential loans versus commercial residential loans. A residential loan would be on a residence that is from 1 to 4 units. So like a single family or a duplex or a triplex or a fourplex. A commercial residential loan is 5 units and up. Now the main difference between these loans is that a residential loan is qualified based on the person getting the loan. The commercial loan is based upon the property. Instead of looking at cash flow situation of the person, a commercial loan is based on the cash flow situation of the property. This is why for some people, like me, it's easier to get a commercial loan than it is to get a residential loan. An important thing to understand is how mortgages work over time. When you first get a mortgage, your payments are mostly interest. And as time goes on, you're paying down the debt. So the principal is going down. And assuming that you have a fixed rate loan, your payment stays the same. Property taxes and your insurance costs may change a little bit, but your basic payment for your loan is going to stay the same. And more of that payment will go towards the principal and less will be going towards the interest. So the longer you're in the loan, the faster the principal gets paid down. So towards the end of the loan is where you're paying mostly principal. If you buy a house and you put down less than 20% as your down payment with a qualified mortgage, you're going to be required to carry PMI or private mortgage insurance. This insurance is to protect the lender. In case you default on your loan, the private mortgage insurance will cover some of that loss for the lender. Not the whole thing, but a portion of it. The private mortgage insurance, though, it doesn't stay connected to your mortgage for the life of the mortgage. Once you've paid down your loan to 80% of the original purchase price, you can request to have the PMI, the private mortgage insurance, removed. However, once you get down to 78% of the purchase price of the property, then the mortgage company is required to remove the PMI automatically. But I would keep an eye on that if I were you, because I wouldn't trust the mortgage companies to do that on their own, even though they're supposed to. Your lender will want you to also have property insurance that would cover the property. So Private mortgage insurance covers the lender for the loan, but property insurance covers the property in case something happens to the property. Some lenders are going to want you to have enough to cover the amount of the loan, and some lenders are going to want to have enough to rebuild the property if necessary. And they're going to be listed on the insurance policy. And in order to make sure premiums are getting paid every month, most lenders will escrow premiums for the property insurance and also for the property taxes. So that will be added on to your mortgage payments, an amount that then will go into escrow, which is like it's a holding account where the funds will be held until it's time to pay the insurance bill or to pay the property tax bill, and then the escrow company will take care of that. If your property taxes go up or your property insurance goes up, then the escrow company may make adjustments to your monthly payment in order to cover that. But your mortgage payment will stay the same if you have a fixed rate. Depending on where the property exists, some lenders may require additional insurance like hurricane insurance, earthquake insurance, flood insurance. Flood insurance can be really expensive if you're in a flood zone. So those are all other factors that you must consider when you're buying a property, when you're considering the affordability of a property. Another thing to be aware of, gosh, there's so much. Another thing to be aware of are closing costs. Now, you're going to have your broker fees for your mortgage broker. You're going to have your origination fees for your loan. You're going to have like different kinds of document fees. They're going to charge you for pulling your credit report. They're going to charge you for getting an appraisal of the property. Some of them have a loan application fee. And the costs and the charges and the fees all vary from lender to lender. So it's a good idea to get quotes from several different lenders before you decide on one. So that's all I have for you today on mortgages. I know it was a lot to take in. I hope this information was beneficial to you, and I'll see you next time. And that's it for today's show. See you next time.